The Wall Street Journal. First article from Journal, Claude is taking the AI world by storm, about Anthropic's Claude AI model and its widespread adoption. There's a moment happening right now in the technology industry that I think people are fundamentally underestimating. It's not the typical Silicon Valley hype cycle. This is different. This is the moment where a tool becomes so capable that it collapses the economic value of entire skill sets overnight. I'm talking about what people are calling getting Claude-pilled. And the Wall Street Journal reported on this because it's not really a tech story anymore. It's a story about capital allocation, about disruption, about what happens when a founder builds a tool that immediately threatens to destroy the very market you're trying to enter. Let me start with the data that nobody is really paying attention to. Over the holidays just past, software engineers and executives and investors did something unusual. They stopped working on their regular jobs, and they spent their vacation time testing Claude code. This isn't typical behavior. This isn't the kind of thing that happens with minor product releases. People took what they call Claude benders, spending entire days running code through Anthropic's latest model, Claude Opus 4.5, which works inside a desktop coding tool called Claude Code. Here's what happened. Malte Ubel, the chief technology officer at Vercel, took one of these tools during his vacation and finished a complex software project in 1 week. He said that same project would have taken him about a year without the AI. 1 week versus 1 year. He was spending 10 hours a day testing it. He said each run, each completion, each build felt like hitting a slot machine in Vegas. An endorphin rush. That's the language being used. But here's where it gets uncomfortable. A software engineer named Andrew Duca, who has been coding since middle school, said something that I think captures the entire moment. He said, "I spent my whole life developing this skill, and it's literally one-shotted by Claude code. One shot, a decade of mastery, gone. Replicated instantly by a thinking machine that costs a few dollars to access." And the wildfire spread beyond engineers. Non-coders started building software for the first time in their lives using Claude code. They posted about it on social media. They described building their first program ever without knowing how to code. Some described a feeling of awe, which immediately turned into sadness when they realized the expertise they had spent entire careers building up could be replicated in minutes. That's the inflection point. That's the moment we're living in right now. Now, let me explain who built this and what incentives are actually at play. Dario Amodei is the CEO of Anthropic. Anthropic is one of the 2 leading AI startups in the world, alongside OpenAI. Both companies lose billions of dollars. Let me repeat that. They both lose billions annually. But Anthropic and OpenAI are competing in different markets, with different customer bases, and crucially, with different visions of where this technology goes. OpenAI built ChatGPT as a consumer product. Broad, global, millions of users. Anthropic, by contrast, has been focused on business customers. Enterprise. The startup had a larger market share of enterprise users as of mid-2025, according to venture capital data. That's the strategic difference. But here's what matters more. Amodei is acutely aware of what Claude is doing to the labor market. He gave an interview at Davos just after the Claude code release, and he said something that revealed the actual tension inside his own company. He said he's both excited and worried about the impact of AI on employment. He predicted that AI will spur significant economic growth, which sounds great, but he also predicted it could lead to widespread unemployment and inequality. Listen to what he said about this. "I don't think there's an awareness at all of what is coming here and the magnitude of it." That's the founder of the company that built the tool, talking about his own tool. He's literally warning that the world isn't prepared for what his product is about to do. This is the capital allocation tension I want to focus on. Anthropic is losing billions of dollars to build Claude. The tool is working so well that it's about to eliminate the economic value of skills that millions of people depend on. But Amodei is a serious thinker. He's not hiding from this. He's being explicit about the risk. Let me explain what Claude Code actually does, because the technical capability matters less than the business implication. Prior to this release, AI code writing tools were compared to a junior software developer. That was the benchmark. You could use them, but a senior developer still needed to catch the mistakes, still needed to design the system, still needed to understand the architecture. The tool was an assistant. Claude Code is something different. Ubel's example is illustrative. A week versus a year. That's not an assistant capability. That's substitution. And beyond engineering, people are using Claude Code for data analysis on health records, for compiling expense reports, for tasks that seem simple but that previously required a person to have learned specific tools, specific languages, specific workflows. The tool generalizes, it adapts. It doesn't require the human to understand the domain deeply. That's the economic collapse I'm talking about. Now let me do the capital allocation autopsy. What did Anthropic expect when it built Claude? The company started with a thesis. We're going to build safer AI through constitutional methods. We're going to focus on enterprise customers. We're going to be different from OpenAI by being more trustworthy, more careful about alignment, more focused on business use cases. That was the theory. What actually happened? Claude became so capable that it's not just an incremental improvement on prior coding tools. It's a leap. And the distribution of that tool through Claude Code means it's available to anyone with a computer. Non-coders can build software. Junior developers can do the work of senior developers. The economic value of a decade of learned expertise collapses. Anthropic still loses billions. OpenAI still loses billions. Neither company has figured out how to monetize this at a level that justifies the cost structure. But the damage to the labor market, the disruption to educational institutions that teach programming, the collapse of junior developer salaries, that's all real and immediate. The opportunity cost for Anthropic was significant. Every dollar spent on compute to train Claude was a dollar not spent on other initiatives. But the real opportunity cost isn't financial in the short term. It's the social cost. Amadei literally said so. The hidden trade-off? Anthropic has built a tool that makes its own founding thesis. Safe AI is our advantage. Somewhat irrelevant. If Claude is so capable that it eliminates the need for human expertise, then the question of whether it's aligned or not becomes secondary to the question of whether jobs exist anymore. This is what I mean by capital allocation failure at a deeper level. It's not that Anthropic spent too much on compute, it's that Anthropic built a tool without really thinking through the second and third order consequences. Or rather, Amadei thought about it and said so publicly, which suggests the company has made a decision to accept the disruption as a cost of progress. Let me extract 3 timeless lessons from what we're seeing happen right now. First lesson. When a tool becomes so good that it destroys the economic value of the expertise required to build it, you've crossed a line that can't be uncrossed. This isn't a normal product cycle. Junior developers won't come back. Software engineering as a path to the middle class is fundamentally different now. This is what Amadei was trying to warn about at Davos. Success at this scale has real social costs that venture capital returns can't justify. Second lesson. A founder who understands what his product is going to do to the world and says so publicly is rare. Most founders hide or minimize or dodge. Amadei walked into a room and said, "I'm worried about unemployment and inequality, and I don't think people understand the magnitude of what's coming." That's intellectual honesty. That's also an admission that the capital he's deployed has consequences he can't control. And it's a reminder that even a founder thinking carefully about the future can't always avoid building something that disrupts in ways he didn't fully anticipate. Third lesson. The companies losing the most money are often the ones creating the most disruption. OpenAI burns billions. Anthropic burns billions. Neither has a clear path to profitability at current burn rates. But both are reshaping labor markets, educational systems, and the economic value of human expertise. The economic model is broken, but the power is real. This is the pattern we see again and again. The capital-intensive phase of disruption doesn't reward the disruptor for years. But the disruption is happening anyway. Now here's what I'm convinced of. Anthropic has built something real. Claude Code is not hype. The people getting Claude pilled aren't delusional. They're seeing an actual capability jump. But the company is now in a bind. It can't uncreate the tool. It can't walk back the capability. All it can do is try to build a sustainable business model around a product that is actively destroying the market it's trying to serve. The real tension is this. If Claude gets better, the labor market disruption accelerates. If Claude gets worse or reaches a plateau, Anthropic's competitive advantage vanishes, and it becomes just another AI company. There's no middle ground. There's no scenario where this plays out with gradual, manageable change. That's why Amadei was worried enough to say it out loud. This isn't about alignment or safety or constitutional AI anymore. This is about the fact that Anthropic has deployed capital to build a tool that works so well it might break the economy it was supposed to serve. And nobody at Anthropic, including Amodei, has a convincing answer for what comes next. The one sentence to remember is this: a founder who builds a tool that collapses the economic value of the skill required to use it has won at business, but may have lost at society. And if that founder is honest about it, like Amodei is, that's the only integrity we're going to get. Moving on to the next title, Spider-Man star non-alcoholic Barrow gets new funding. Tom Holland's $100 million beer bet. It usually comes in year one. You either prove the market wants your product beyond the novelty of who's attached to it, or you become a shelf-warming historical footnote. Barrow just crossed that line. And the Wall Street Journal reported on this, not because Tom Holland launched a non-alcoholic beer brand, but because what happened after launch reveals something crucial about how capital actually gets deployed when founders understand both their product and their constraints. Let me start with what actually happened in Barrow's first year, because the numbers matter. Tom Holland and John Herman launched Barrow in late 2004. Just a few months later, the company reached nearly $10 million in revenue in its first year. $10 million in a category, non-alcoholic beer, that was barely a blip in the American alcohol market not long ago. Now stop there. That number doesn't sound remarkable until you understand what it means for a founder like John Herman. Herman isn't a celebrity trying to slap his name on something. He's an operator. He previously served as president of C4 Energy, which was part of the Nutrabolt beverage company. He's run real companies. He knows what scaling a beverage brand actually requires. So when Herman says Barrow expects to reach almost $30 million in sales this year, that's not hype. That's a tripling of revenue in year two. That's the inflection point I'm talking about. But here's where the capital allocation story gets interesting. Payne Schwartz Partners, a private equity firm, just led an investment in Barrow that values the company at more than $100 million. $100 million valuation for a company that did $10 million in sales in its first year. That's a 10x revenue multiple on year one numbers. Now, most people look at that valuation and think, celebrity tax. Tom Holland is a Spider-Man star. Of course, his vanity project gets overvalued. But that's lazy thinking. That's missing what's actually happening here. Kevin Schwartz is the CEO of Payne Schwartz. He explained the investment thesis explicitly. Payne Schwartz is investing through something called Better Co. Holdings. This is a portfolio company within their sixth flagship fund. And the entire fund was designed for one specific purpose: to hold minority stakes in better-for-you food and beverage businesses. That's the structure. Not control. Not a board seat forcing strategic direction. Minority stakes. This is important because it tells you what Payne Schwartz actually believes the constraint is. Schwartz said he expects Better Co. to hold 5 to 10 investments. Barrow is the third. The typical investment range is $10 to $25 million. This investment falls within that range. So Payne Schwartz isn't betting the farm on Barrow. It's building a portfolio of better-for-you beverages. But here's the tension. Here's what makes this a capital allocation story. Barrow is a founder-led business run by John Herman. It has an existing backer already, William Morris Endeavor Entertainment, a major talent agency. It also has Imaginary Ventures, a venture capital firm, and now Payne Schwartz. This company went from 0 to 10 million in sales while being backed by a talent agency and a venture firm. That's unusual. Usually talent agencies are terrible at building beverage companies. They're in the business of representing people, not scaling products. But William Morris brought something different. They brought distribution leverage and credibility at the celebrity level. And Imaginary Ventures brought venture capital discipline. Logan Langberg, a partner at Imaginary Ventures, described the investment as validation. He said, "This first external raise is not just a milestone, but a validation of what's been achieved in a single year." That language matters. It's not excitement. It's validation. It's the venture firm saying, "We tested this, we measured it, and the market is real." Not the celebrity halo. The market. Now let me explain what Barrow actually does differently, because that's where the capital allocation thesis lives. Barrow offers 4 types of beer, including 2 IPAs. It's a non-alcoholic beer brand. At first glance, that sounds like a trend. Non-alcoholic beer has become somewhat fashionable in recent years, especially in markets like the UK. where Barrow is based. But John Herman's background tells you something different. He came from C4 Energy. He knows the energy drink market. He knows how to build consumer brands that have repeat purchase behavior. He's not a beer guy trying to make non-alcoholic beer. He's a beverage operator applying category expertise to the non-alcoholic segment. Herman said something that reveals the entire strategy. We weren't just looking for capital. We were looking for great partners that could help us grow. That's not a celebrity founder asking for money. That's an operator asking for specific capabilities. And it tells me that Herman identified a constraint that wasn't cash. It was distribution, infrastructure, and knowledge about scaling in the better-for-you beverage space. That's why Payne Schwartz makes sense. Payne Schwartz isn't a venture capital firm trying to 100x its money. It's a growth equity firm investing through a dedicated portfolio company in a specific category, better-for-you beverages. They bring relationships with distributors. They bring experience scaling consumer brands. They bring operational knowledge that a talent agency, however creative, can't provide. Let me do the capital allocation autopsy now. What did Barrow expect when it launched? The company launched with a simple thesis. There's demand for non-alcoholic beer that tastes good. The market is growing. We have a founder who understands beverages. We have celebrity credibility from Tom Holland. We have initial backing from William Morris Endeavor, a talent agency with distribution leverage. What actually happened? The company hit $10 million in sales. That's real. But more importantly, the investors who put in early capital, William Morris and Imaginary Ventures, now have validation that the business is scalable. This round with Payne Schwartz isn't raising at a higher valuation because of hype. It's raising because the numbers proved something. The opportunity cost for Payne Schwartz is interesting. Every dollar invested in Barrow is a dollar not invested in another beverage company. But Payne Schwartz said they expect 5 to 10 investments in the Better Co fund. So Barrow isn't the only bet. It's the first test case. If Barrow's trajectory continues, it validates the entire thesis for the other 4 to 9 investments. The hidden trade-off is this. Barrow has multiple stakeholders now. Tom Holland is still the face, but this isn't his company anymore in any operational sense. It's a platform for Payne Schwartz to test whether minority stakes in founder-led better-for-you beverage companies can generate returns. That changes the decision-making calculus. Herman wants to triple revenue this year. He wants to double his sales team. He wants to significantly expand distribution. Those are aggressive targets. And with Payne Schwartz as an investor, there's now scrutiny on whether those targets are achievable or optimistic. This is what I mean by capital allocation at a deeper level. It's not just about raising money. It's about understanding who you're taking money from and what incentives that creates. Let me extract 3 timeless lessons from what's happening with Barrow. First lesson: a founder who has already built one beverage company will outperform a founder with celebrity but no operational experience. John Herman's background at C4 Energy and Nutrabolt is more valuable to success than Tom Holland's fame. The fame gets investors' attention. The operations get the company to profitability. Herman's strategy of saying, "We want great partners," tells me he understands this distribution of value. He's using the celebrity as one asset among many. He's not betting everything on it. Second lesson: when a growth equity firm builds a portfolio company to hold minority stakes in a specific category, it's making a statement about where it sees opportunity. Payne Schwartz isn't trying to control Barrow. They're trying to understand the better-for-you beverage market by holding multiple bets within that space. That suggests they see structural tailwinds in that category: premiumization, health consciousness, younger consumers willing to pay more for products aligned with their values. They're building conviction through portfolio diversification, not single company concentration. Third lesson: a celebrity founder combined with an operational founder can work, but only if the operational founder maintains decision-making authority. Tom Holland's job is to be the face. John Herman's job is to run the company. Those roles are clear. The capital raised is flowing to Herman's vision of scaling distribution and hiring sales talent, not to celebrity marketing or brand building. That alignment is what separates Barrow from the typical celebrity vanity project that burns through capital on above-the-line marketing and never achieves unit economics. Now here's what I'm convinced of. Barrow will likely reach $30 million in sales this year. The founders have proven they can scale. John Herman has operational credibility. The non-alcoholic beer category is tailwinds. Payne Schwartz isn't betting that Barrow becomes a $10 billion company. They're betting that the category is real, the founders are capable, and a minority stake at a reasonable valuation generates 8 to 12 times return over a 5 to 7-year hold. That's the actual thesis. Not celebrity halo, not hype, not a vanity investment. It's a growth equity firm with specific thesis conviction testing. That thesis with a capable founder and a celebrity asset that happens to be attached. The real test comes next. Can Herman triple revenue while maintaining the unit economics that got him to $10 million in year one? Can Payne Schwartz deploy the Better Co strategy across 5 to 10 other investments without hitting saturation in the category? Can the non-alcoholic beer market grow at 30 to 50% annually for the next 5 years? Those are the real capital allocation questions. The one sentence to remember is this: a celebrity founder attached to an operational founder, backed by growth equity focused on portfolio building rather than control, is often a more sustainable model than either of those founders alone. Moving on to the next title, Ozempic maker tries new ad track. Get a Mac. Moment. There's a moment in pharmaceutical history when you can actually see a company admit defeat without using those words. When a massive, multinational drug maker suddenly pulls out the checkbook and pays $2.2 billion for something it doesn't yet have. That's the moment we're looking at right now. GSK, the British pharmaceutical giant, just agreed to acquire RAPT Therapeutics, a California biopharmaceutical company, for approximately $2.2 billion. The deal values each RAPT share at $58, with $1.9 billion in upfront cash investment. This isn't a strategic masterstroke. This is a company that got caught sleeping and is now trying to buy its way back into relevance. And the Wall Street Journal reported on this because it reveals something crucial about how the pharmaceutical industry allocates capital when its primary business model is evaporating. Let me start with what just happened to the market leader. 2025 was supposed to be Novo Nordisk's year. Novo Nordisk owns the GLP-1 market, Ozempic, Wegovy, the weight loss drugs that have created one of the most valuable pharmaceutical narratives of the decade. Novo Nordisk should have been printing money. Instead, Maziar Mike Dozdar, the CEO, walked into the JP Morgan Healthcare Conference and said something you almost never hear from a CEO. 2025 was a difficult year. I will not belittle that one bit. That's the language of defeat. What happened? Patents expired. Semaglutide, the key ingredient in both Ozempic and Wegovy, lost exclusivity in a number of markets. And suddenly, Novo Nordisk went from having a near monopoly to competing with Eli Lilly, Amgen, and a flood of other manufacturers making the same drug. The company's high market share collapsed almost overnight because the barrier to entry disappeared. Dozdar said it directly. Because in a number of markets we have lost exclusivity this year, we will get competition. And when you have a very high market share, competition will take some of that share away. That's the inflection point. That's the moment when a company realizes it's not special anymore. The drug works the same. The manufacturer doesn't matter. It's a commodity now. But here's where the larger pharmaceutical industry is paying attention. Because what happens when your blockbuster drug loses exclusivity? You need a new blockbuster drug. And if you don't have one, you have to buy one. That's why GSK is spending $2.2 billion. Now let me explain who RAPT Therapeutics actually is and what GSK is actually buying. RAPT is a California-based biopharmaceutical company working on respiratory, immunology, and inflammation treatments. But the real asset GSK is acquiring is something called ozuriprubart. That's an antibody in development for protection against food allergies. Let me stop there and let that sink in. An antibody in development for food allergies. Data from trials are expected in 2027. We don't even know if it works yet. GSK is paying $2.2 billion for a drug candidate that hasn't completed phase trials. This is not a proven asset. This is a bet. This is capital allocation based on hope and conviction about a market that may or may not exist. Tony Wood is the chief scientific officer at GSK. He said this: the addition of ozuriprubart brings another promising new potential best-in-class treatment to GSK's pipeline. Notice the language. Promising, potential, best-in-class. All words that mean, we don't know if this will work, but we think it might be worth $2.2 billion. Now, let me explain the market opportunity that justifies this price. Around 6% of adults in the United Kingdom have a food allergy. That's approximately 2.4 million adults. 6% might not sound like much, but if you're a pharmaceutical company looking for an indication that affects millions of people and has no proven treatment, that's a market. And here's the key insight. The treatment GSK is acquiring could offer less frequent dosing than alternative drugs. That's the selling point. Not a cure, not a revolutionary mechanism, just convenience, the ability to take a drug less often. Russ Mold is an investment director at AJ Bell. He said this in a note to clients. If GSK can crack the formula for a more convenient treatment, it stands to potentially make big bucks. That's the entire thesis. Convenience equals money. A drug you take 4 times a year instead of 12 times a year. A patient compliance story. That's what GSK paid $2.2 billion to acquire. Now let me do the capital allocation autopsy. What did GSK expect when it started looking for acquisitions? The company is facing a problem shared by every large pharmaceutical firm. Patent cliffs, blockbuster drugs losing exclusivity, revenue that was guaranteed to decline as generics flooded the market. GSK needed new assets. It needed a pipeline refresh. It needed drugs with years of patent protection remaining. What actually happened? GSK found RAPT, a company developing a drug for food allergies that might offer convenience advantages over existing treatments. The company paid $2.2 billion for the asset and the approval process to come. The opportunity cost for GSK is massive. $2.2 billion in cash is capital that could have been deployed elsewhere. Capital that could have been returned to shareholders. Capital that could have been invested in internal research and development to build something proprietary. Instead, GSK is paying a premium for something someone else developed, something that might not work, something that even if it works will compete in a market that might be smaller than executives are betting. The hidden trade-off is this. By acquisitions, GSK is admitting its internal research and development capability isn't enough. It's admitting it can't build blockbuster drugs on its own. It has to buy them. That's not a sustainable long-term strategy. It's a band-aid on a broken business model. Now, here's what matters. What makes this a capital allocation failure at a deeper level? The pharmaceutical industry has a structural problem. Patent protection lasts a finite number of years. Then generics destroy profitability. That's the business model. Every major pharma company knows this. Every CEO walks into the JP Morgan Healthcare Conference and talks about portfolio refresh and pipeline strength and clinical trials. But what they're really saying is, we need new drugs and we can't develop them fast enough internally, so we're going to pay a premium to acquire early-stage assets and hope they work. That's not investing. That's desperation disguised as strategy. Let me extract 3 timeless lessons from what GSK is doing. First lesson. When a company's primary barrier to entry disappears, it becomes a commodity manufacturer overnight. Novo Nordisk's GLP, one monopoly didn't gradually erode. It collapsed. Patents expired. Suddenly, there was no reason a pharmacy would prefer one manufacturer's semaglutide over another's. The market moved from differentiation to price competition in months. That's what happens when you're protecting a business model with intellectual property, and the intellectual property expires. You have nothing left. Second lesson. Acquiring early-stage assets is expensive and risky, but it's often cheaper than the alternative. GSK is paying $2.2 billion for ozuriprobart because developing a comparable drug internally would cost more in both time and capital. The company would need 10 to 15 years of research and development. RAPT accelerates that timeline. GSK is paying for acceleration and risk transfer. That's not a bad decision if the market opportunity is real and the drug candidate has potential. It's a bad decision if you're doing it reflexively because your internal development engine is broken. Third lesson. Convenience is an underrated value driver in pharma. A drug that works the same as competitors but requires less frequent dosing creates patient stickiness, improves compliance, and justifies premium pricing. If ozuriprobart works and requires dosing 4 times a year instead of 12 times a year, that's a differentiation opportunity. GSK is betting that convenience equals customer lifetime value. That bet could pay off. Or it could be another example of a pharma company overpaying for a marginal improvement. Now here's what I'm convinced of. GSK is doing what every large pharmaceutical company has to do. In a world where patents expire and blockbuster drugs become commodities, it's trying to build a pipeline faster than its internal research engine can produce. The wrapped acquisition is logical in that context, but it's also evidence of a deeper problem. The pharmaceutical industry has built a business model on temporary monopolies created by patents. When those monopolies expire, the company has to find new ones. That requires either internal innovation or external acquisition. Most companies can't innovate fast enough, so they acquire. GSK paid $2.2 billion for a problem it should have solved internally. That's not a judgment on the RAPAT deal specifically. It's a judgment on the pharmaceutical industry's capital allocation discipline. The real test comes in 2027 when Osier-Reprobart trial data arrive. If the drug works and shows clinical advantages, GSK's investment could return multiples. If the drug fails or underperforms expectations, this is a $2.2 billion write-off disguised as innovation. That's the risk GSK is taking, and that's the capital allocation problem the entire pharmaceutical industry is facing. The one sentence to remember is this: pharmaceutical companies that need to buy late-stage drug candidates to fill patent cliffs have already lost the innovation game. They're just managing the decline with other people's assets. Moving on to the next title, SpaceX spat ends in loss for activist Weinstein. SpaceX, activists, and the old guard of British finance. There's a moment in activist investing when you realize the rules of the game are different in places you didn't expect. When your arguments are sound, your logic is unassailable, and the shareholders still vote to reject you with overwhelming force. That moment just happened to Boaz Weinstein. The Wall Street Journal reported on it, and the story reveals something fundamental about how power really works in finance. It's not about having the best argument. It's about having the trust of the people you're arguing to. Boaz Weinstein is one of the most successful activist investors in the world. He's the hedge fund raider who took down a JP Morgan Chase trader known as the London Whale. He has a well-documented playbook for finding closed-end funds and investment trusts that trade at discounts to their underlying asset values. He buys discounted shares. He pushes for board changes. He forces managers to either improve performance or let investors cash out. It's worked repeatedly. He has wins against investment giants like BlackRock. But on this question, in this fund, with this board, he lost. Spectacularly. Let me explain what he was trying to take control of. Edinburgh Worldwide Investment Trust is a UK-based investment trust managed by Baillie Gifford, a legendary British asset manager. The trust owns a portfolio of global equities, but it has one crown jewel, a $185 million stake in SpaceX, the Elon Musk rocket company that's targeting what might be the largest IPO in history. That's the magnet. That's why Weinstein looked at Edinburgh Worldwide and saw an opportunity. A fund holding a valuable SpaceX stake. A fund potentially undervalued by the market. A fund managed by what Weinstein saw as a complacent board making questionable decisions about its most valuable asset. In November, Weinstein boosted his stake in Edinburgh Worldwide to roughly 30%. He launched a formal bid to oust the board. He said the fund had underperformed. He said he had no faith in the investment managers. He demanded that shareholders give him the power to install new directors who would consider replacing Baillie Gifford as manager. If that happened, Saba Weinstein's firm would get the management contract. Saba would collect the fees. Saba would control what happens to the fund's assets. That's the incentive structure. That's why activist investors target these funds. Not for altruism, for power and fees. Now, here's the inflection point that matters. In recent years, SpaceX's valuation has increased significantly. And in December, Baillie Gifford made a decision that would haunt Weinstein's entire campaign. It reduced Edinburgh Worldwide's SpaceX stake because the position had become too large relative to the fund's total holdings. The trust tries to keep single positions below 10% of the portfolio. The SpaceX stake had grown beyond that as SpaceX's valuation climbed. Weinstein saw this and attacked. He said Baillie Gifford was incompetent. He said that SpaceX's valuations have historically increased when the company conducts December stock sales. He said shareholders should have been consulted. He threatened to sue. His argument was compelling on the surface. A legendary asset manager sold a valuable stake months before the company's valuation doubled. That looks like a mistake in hindsight. But here's what actually happened. Other shareholders didn't see incompetence. They saw prudent portfolio management. They saw a fund sticking to its discipline. Excluding shares held by Saba itself, nearly 93% of other shareholders voted against Weinstein's bid to oust the board. 93%. That's not a close call. That's not a debate. That's a decisive rejection. A research analyst named Xaver Halberstadt from Winterflood Securities said this was not many ways to describe this other than a grand victory for Edinburgh Worldwide, against the odds. Because last year, Weinstein had actually scored some victories. He had built stakes in 6 other British investment trusts alongside Edinburgh Worldwide. Several of those funds had returned cash to shareholders or changed their strategies as a result of his pressure. The British financial establishment had not treated him kindly. One tabloid branded him a ruthless corporate raider. But his strategy was working. This year was different. Edinburgh Worldwide ran a campaign to stop Saba. They fought alone, without the coalition of other funds that had defended themselves collectively the previous year, and they won decisively. Now, let me do the capital allocation autopsy. What was Weinstein's thesis when he built his stake in Edinburgh Worldwide? His argument was straightforward. The fund owns a $185 million SpaceX stake. SpaceX is worth billions and heading toward a massive IPO. The fund is managed by a board that's making questionable decisions, like selling SpaceX at potentially the wrong time. If I can replace the board with directors aligned with me, I can improve decisions, improve returns, and unlock value for shareholders. And incidentally, I'll collect management fees in the process. What actually happened? Shareholders voted overwhelmingly to keep the existing board. They rejected Weinstein's argument that Baillie Gifford was incompetent. They looked at the decision to reduce the SpaceX stake and saw prudent diversification, not a mistake. The opportunity cost for shareholders who sided with the board is becoming clear. If SpaceX's valuation has truly doubled or is about to double with an IPO, Edinburgh Worldwide's reduction in SpaceX exposure means shareholders missed upside. That's a real cost. But the opportunity cost for Weinstein is also real. He owns roughly 30% of a fund he can't control. He can't push it toward his preferred manager. He can't influence investment decisions. He's locked into a fund where 93% of other shareholders disagree with him. That's not activism anymore. That's just being a minority shareholder with no power. The hidden trade-off is this. Baillie Gifford made the decision to reduce SpaceX exposure based on portfolio discipline. Keep single positions below 10%. That discipline forced them to sell before the company's valuation jumped. The decision looks foolish in hindsight, but the shareholders are saying, we trust Baillie Gifford's long-term judgment even when individual decisions look questionable in isolation. That's a belief. That's faith in institutional management and governance. Weinstein was betting that shareholders would care more about short-term performance than about long-term trust in their current manager. He was wrong. Let me extract 3 timeless lessons from what just happened. First lesson. Activism works when the existing management is clearly failing and the manager is replaceable. Weinstein's previous victories happened at funds where management underperformance was obvious and shareholders were already frustrated. Edinburgh Worldwide was different. Yes, the SpaceX sale looks questionable in hindsight, but overall, the fund is working for its shareholders. The board has credibility. Baillie Gifford has a legendary reputation in British finance. You can't overcome institutional credibility with a single decision that looks bad after the fact. Second lesson. Being a 30% shareholder is not the same as having control. In the US, with closed-end funds, Weinstein has been able to win board seats and push through changes with smaller stakes. In the UK, the institutional establishment is clubbier. The shareholders voting against him included other institutional investors who know Baillie Gifford, who trust the British financial system, who aren't interested in handing control to a hedge fund raider. Cultural factors matter more than financial analysis sometimes. Third lesson. Trust is a long-term asset that can't be conquered through clever arguments. Weinstein built his reputation as a killer trader and activist investor. That reputation helped him succeed in the US, but in the UK, reputation worked against him. He was branded a corporate raider. Shareholders viewed him with suspicion. His arguments about SpaceX underperformance were logical, but they came from someone shareholders didn't trust to act in their interest if given control. Now here's what I'm convinced of. Boaz Weinstein is right about one thing. The decision to sell SpaceX shares before the valuation jumped was suboptimal. Hindsight is perfect, but if SpaceX truly doubles in value, Edinburgh Worldwide's shareholders will have regretted the sale. But Weinstein was wrong about the cure. The cure wasn't to replace the board with his own directors and give Saba control. The cure wasn't to sacrifice long-term trust in Bailey Gifford for short-term outperformance on a single position. What Bailey Gifford did was prioritize consistency and discipline over being right on every individual call. That's often the superior long-term strategy, and shareholders voted to confirm it. The real lesson here is about incentives and whose interests they serve. Bailey Gifford makes its money from managing assets over decades. It cares about long-term reputation and institutional stability. Saba makes its money from successful activist campaigns and from fees it can collect if it manages funds. The incentive structures are fundamentally different. Shareholders chose the long-term institutional incentives over the short-term activist incentives, and they won the vote by 93%. That's not because Weinstein's logic was flawed. It's because shareholders decided that Bailey Gifford's logic, keep positions disciplined, avoid concentration, maintain portfolio balance, is more trustworthy than Saba's logic. The one sentence to remember is this: in markets where institutional credibility is built over decades, no activist argument can overcome it in a single shareholder vote, no matter how logically sound that argument appears. Moving on to the next title, Halliburton and oil services rivals can't wait to return to Venezuela. There's a pattern in resource extraction that repeats across decades and continents. When a country falls into chaos and a new regime takes over, the biggest capital commitments don't come first. The services companies come first, the equipment providers, the technical specialists. And the Wall Street Journal just reported on exactly this moment happening in Venezuela. Mark Malik, a chief investment officer at Siebert Financial, said it perfectly. Oilfield service companies are often the quiet beneficiaries of chaos turning into order. That's the entire story right there. Chaos turning into order. And while the major oil producers, Exxon, Chevron, are being very cautious, the services companies are moving fast. Let me explain why their incentive structures are so different. Venezuela produces less than 1 million barrels of oil per day. 2 decades ago, it was producing more than 3 million. That's the collapse. Mismanagement, underinvestment, nationalization, corruption. The country has the world's largest proven oil reserves and the lowest production in the region. It's an inversion of reality. Then in January, the political situation shifted. The Nicolas Maduro regime fell, and suddenly, President Trump began talking about American oil companies flooding back into Venezuela to rehabilitate production. He talked about $10 billion. He talked about American oil companies making tremendous wealth and sharing it with Venezuela. But there's a crucial distinction in how different companies are responding to that opportunity. ExxonMobil, one of the largest oil producers in the world, walked into a White House meeting in early January and basically said no thanks. CEO Darren Woods said something that reveals everything about capital allocation under political risk. He said, "We've had our assets seized there twice. You can imagine to re-enter a third time would require some pretty significant changes from what we've historically seen here and what is currently the state." That's code for, we need guarantees, real legal protections, financial assurance, proof that this time is different. Trump's response was immediate and public. He said he was inclined to keep Exxon out. Now contrast that with what Halliburton said. Jeff Miller is the chief executive of Halliburton. He walked into the same White House meeting and said something very different. He said, "We left only because of U.S. sanctions that were put in place and have effectively been evaluating how to return ever since. I see this as that moment in time where we get to execute on plans to return." Trump was pleased. He said, "Great job. You'll be back." Why did these companies respond so differently to the same opportunity? It comes down to capital allocation and risk appetite. ExxonMobil is a major oil producer. It would need to commit billions to rehabilitate Venezuela's fields, hire staff, negotiate with the Venezuelan government, build infrastructure. It has massive shareholder capital at risk. Exxon had assets seized twice before. From a shareholder perspective, that's not just risk. That's evidence of broken contracts, uncompensated losses, and a pattern of expropriation. Halliburton is a services company. It doesn't own the oil. It doesn't operate the fields. It sells equipment. It provides technical expertise. It performs work under contracts. When a services company works in a country, its capital at risk is much smaller and much more mobile. That's the structural difference. Let me explain what Halliburton's background actually is, because it matters. Halliburton started working in Venezuela in 1938. That's over 85 years ago. The company built operational facilities, equipment, local personnel networks. It was embedded in the Venezuelan economy for decades. Then, in 2019, because of U.S. sanctions on Venezuela, Halliburton left. It abandoned its assets. Those assets are still there. Equipment, facilities, years of infrastructure. Jeff Miller, the current CEO, was actually in Venezuela when Hugo Chavez came to power and nationalized the energy industry. Miller was the head of business development for Halliburton at that time. He's a fluent Spanish speaker. He was stationed in Venezuela. He raised his children there. That personal history matters because it shapes incentives. Miller isn't just looking at Venezuela as a capital allocation problem. He's looking at it as unfinished business, a market he knows intimately, a place where Halliburton already has credibility, relationships, and operational knowledge. When he told Trump that Halliburton was very much interested in returning, that wasn't just flattery. It was a sincere statement about capital allocation priorities. Now let me explain what Halliburton would actually do if it returned to Venezuela. Miller said the most important early work would be intervention and workover services, getting more barrels out of the wells that are already there. That's the key insight. Halliburton isn't going to drill new wells. It's going to rehabilitate existing infrastructure. It's going to pull more oil out of wells that have been underinvested for 2 decades. That work requires technical expertise, equipment, and execution. It doesn't require Halliburton to own the oil reserves or the production. Analysts estimate that rehabilitating Venezuela's oil fields could require $10 billion per year for many years. That's enormous capital. But who's going to deploy that capital? Simon Wong is a portfolio manager at Gabelli Funds. He said, "There's a lot of money to be spent there. A big chunk will be spent with these companies for the equipment, for their technical knowledge. Halliburton and companies like SLB, Baker Hughes, and Neighbors Industries, they get paid for the work. They sell the equipment. They provide the expertise. They get revenue regardless of whether the overall Venezuela project succeeds or fails. That's the incentive structure. That's why services companies are eager while producers are hesitant." Now look at the stock performance. In January alone, Halliburton was up 13.5%. SLB was up 21%. These companies had already been benefiting from increased drilling in the Middle East and big offshore projects, but Venezuela pushed them higher. Investors understood the capital allocation story immediately. Services companies can win in Venezuela without taking the full political and financial risks that major producers face. Now let me do the capital allocation autopsy. What did the oil services companies expect when Venezuela's political situation shifted? Their thesis was straightforward. Venezuela has the world's largest proven oil reserves. Production has collapsed to less than 1 million barrels per day. The new government and the Trump administration both want to restore production. That restoration requires equipment, technical expertise, and services that only companies like Halliburton can provide. Therefore, our services company will be a beneficiary regardless of which major producer takes the lead on Venezuelan rehabilitation. What actually happened? Major producers like Exxon and Chevron expressed caution. They demanded guarantees, legal protections, and assurance of contract sanctity. They weren't willing to commit major capital without proof that the political situation was stable. But Halliburton got public praise from Trump. It positioned itself as eager and willing. It signaled that it understood Venezuela's history and was ready to move. The opportunity cost for Halliburton was modest. The company doesn't need to commit billions of dollars immediately. It can redeploy equipment from other markets, hire local staff, and execute workover services. The risk is manageable because it's not betting the company on Venezuela's future. But there's a hidden trade-off. Halliburton is making a geopolitical bet. It's betting that Trump's Venezuela policy will be durable, that the new government will honor contracts, that the company won't have its assets seized again. Miller said something revealing. "We didn't leave Venezuela because of the risk. We've worked in markets that I view as much more difficult than Venezuela. I don't see that as a barrier to re-entry." That's false equivalence. Venezuela isn't difficult because of geology or markets. It's difficult because of government expropriation and political risk. And Halliburton has been expropriated before. The company is betting that this time is different because Trump is in power and wants production restored. That's a political bet, not a business risk assessment. Let me extract 3 timeless lessons from what's happening with Venezuela and services companies. First lesson. In resource extraction, the services companies often take risks that the producers won't. Not because services companies are braver or smarter, but because their capital at risk is smaller and their revenue is decoupled from project success. A producer commits billions and only profits if the project works. A services company commits equipment and expertise and gets paid for work regardless. That structural difference creates asymmetric risk appetites. Services companies will take geopolitical bets that producers rationally refuse. Second lesson, personal relationships and history can distort capital allocation decisions. Jeff Miller spent his career in Venezuela. He has personal connections. He understands the culture and language. That embeds emotional commitment into what should be a purely financial decision. The fact that he's personally motivated to return to Venezuela might make Halliburton's management overestimate the company's ability to succeed there. History and relationships are dangerous when they cloud capital allocation judgment. Third lesson, when major players express caution about a supposed opportunity, listen carefully to why. Exxon's hesitation isn't cowardice. It's evidence that the real risks are higher than enthusiasm suggests. The company has been expropriated twice. That's not bad luck. That's pattern evidence. When experienced capital allocators say no to a politically unstable opportunity, their caution is often smarter than optimistic enthusiasm. Now here's what I'm convinced of. Halliburton will probably succeed in the short term. It will provide services. It will get paid. It will return equipment to Venezuela and execute technical work. The question is, what happens when the political situation changes again? Venezuela has a history of expropriation. Hugo Chavez seized assets. Nicolás Maduro seized assets. Both were justified as serving the Venezuelan people. The current government might be different, but it's also new and unproven. Halliburton is betting that Trump's administration will provide sufficient protection. But what happens when Trump leaves office? What happens if the Venezuelan government demands better terms or more favorable revenue splits? What happens if the company's equipment gets seized again? The services company model works great in stable markets. It also works in unstable markets as long as you can get paid and move your equipment out fast. But Venezuela has seized assets twice. That suggests the company can't always extract its assets when it needs to. Halliburton is taking more risk than its capital allocation framework seems to acknowledge. The one sentence to remember is this: oilfield services companies profit from chaos turning into order, but they're often not the ones who benefit when order turns back into chaos. Moving on to the last title. With affordable homes, someone loses. There's a moment in every policy debate when you realize the problem isn't unsolvable. It's impossible. Not because we lack the tools, but because solving it requires harming the wrong people. And those people vote. The Wall Street Journal just published an analysis that makes this explicit. It's about housing affordability, or more precisely, it's about why housing affordability can never be achieved without creating a political catastrophe. 88 million Americans own homes. As of the third quarter of 2025, they were sitting on $34.4 trillion in housing equity. That's a near record, an increase of nearly 90% since right before the pandemic. Those 88 million homeowners are the problem. They're also the solution. They're also the reason nothing will be done. Let me explain the mechanics. Young Americans trapped in the rental market want home prices to fall. That's how they get onto the property ladder. Millions of existing homeowners want values to stay high. That's how their wealth keeps growing. These are irreconcilable interests. You cannot make one group happy without destroying the other. President Trump is aware of this. He's been floating proposals to address housing affordability ahead of the midterm elections. 50-year mortgages, ordering Fannie Mae and Freddie Mac to buy billions of dollars of mortgage bonds to push down borrowing costs, banning Wall Street investors from buying single-family homes, letting Americans tap their 401k retirement accounts for down payments. These are all headline-grabbing proposals designed to make it look like something is being done. But the Wall Street Journal cut through the noise and analyzed what would actually be required to make homes affordable again. The findings are devastating. According to Realtor.com, affordability means a buyer on median household income spends roughly 20% of their monthly pay on principal and interest for a median-priced home. That was the level in 2019, before inflation, before the pandemic. before everything got expensive. To return to 2019 affordability levels with home prices and mortgage rates stuck where they are today, the median household income would need to increase by 56%. That's from roughly $84,000 to $132,000. Wages are rising faster than home values in recent years. But even at that pace, it would take around a decade to inflate incomes to the level required. 1 decade. That's the least painful solution. And it still requires waiting for something that might not happen. The second path is for mortgage rates to fall to 2.65%. That would give home hunters the same buying power they had in 2019. Rates at that level are very unlikely outside of a major recession. And here's the key insight. Lower rates would be counterproductive unless there's a corresponding increase in housing supply, because cheaper borrowing costs would be capitalized into higher home prices. You'd be solving nothing. You'd just be inflating the asset bubble further. The third path is for home prices to fall by 35%. That's the path that makes housing affordable, immediately, permanently, and completely destroys the wealth of 88 million homeowners. Trump acknowledged this tension in December. He said it explicitly. You create a lot of housing all of a sudden, and it drives house prices down. So I want to take care of the people that have houses that have a value to their house that they never thought possible. There it is, the constraint, the political reality. You can't solve housing affordability without harming the homeowners who have concentrated their entire financial lives into property equity. Now let me explain why policymakers can't address this, even if they wanted to. The wealth effect has been propping up consumer spending. Primarily, the stock market boom is responsible for that. But high home prices are helping too. People are beginning to tap their housing equity. Home equity loans are the fastest growing category of consumer credit. Mark Zandi, chief economist at Moody's Analytics, confirmed this. More equity extraction means more consumer spending. More consumer spending means a stronger economy. If home prices fall 35%, that wealth evaporates. So does the spending it was enabling. The government can't accept that economic consequence, even if it solves the housing crisis. So we're trapped. Let me walk through what would be required to actually increase housing supply in a meaningful way. The problem is fragmented governance. Land use restrictions and zoning laws are set by more than 33,000 different local entities across the country. More than 33,000. Each one has the power to restrict supply and protect property values. Each one has homeowner constituencies that benefit from restricted supply. There's no federal policy that can overcome 33,000 local zoning decisions designed to protect home prices. New York State loosened some environmental rules recently to try to speed up housing construction. But that's a drop in an ocean of local restrictions. Now let me do the capital allocation autopsy. What did builders expect when they looked at the housing crisis? Their thesis was straightforward. People need homes. Housing supply is constrained. Demand is strong. We can build, sell, and profit. Home prices will stay elevated because supply is limited. What actually happened? Builders became reluctant to create a flood of new supply. Why? Because if they flood the market with homes, prices fall. Profits fall. Their own assets, which are often real estate holdings, fall in value. So they constrain supply voluntarily. Lennar, one of America's biggest home builders, said on their earnings call that short supply can't be fixed by simply adding supply, because this approach would hurt Americans who have already bought. That's not analysis. That's a declaration of political defeat. The builder is saying, we acknowledge that supply is the solution, but we won't provide it because it would harm existing homeowners. So the housing crisis persists. Builders maintain prices. Homeowners keep their equity. Young renters stay trapped. And the government proposes headline-grabbing policies that don't address the underlying problem. The opportunity cost for society is enormous. Housing supply that should exist doesn't. Capital that should be deployed isn't. Young people delay starting families, starting businesses, building wealth. The economic drag of constrained housing supply compounds across decades. But the opportunity cost for the government is political annihilation. Any politician who solves housing affordability by allowing home prices to fall 35% would lose the votes of 88 million homeowners. In a democracy, that's suicide. The hidden trade-off is this. You can have housing affordability, or you can have a large politically powerful homeowner class. You cannot have both. And since the homeowner class votes, affordability loses. Now let me extract 3 timeless lessons from this housing policy failure. First lesson: when a problem requires harming a concentrated, organized, wealthy group to help a dispersed, unorganized, poor group, the problem will not be solved. Homeowners vote. They donate. They have political power. Young renters lack all of these. That's not a moral failing. It's just how politics works. Policy will never target homeowners for harm, unless the alternative is civilizational collapse. Second lesson: wealth effects are a constraint on policy. When consumer spending is propped up by asset price appreciation, policymakers become hostages to asset prices. They can't let those prices fall because the economic consequences are too severe. This is true for home prices. It's also true for stock prices. It's true for any major asset class that concentrates wealth. Once you've allowed an asset bubble to inflate, you're trapped. You can't deflate it. You can only extend it and pray it doesn't burst. Third lesson: fragmented governance is a feature, not a bug. 33,000 local zoning authorities might seem inefficient, but they're designed to be inefficient. They protect local interests. They prevent supply floods. They keep home prices elevated. From the perspective of existing homeowners, this is perfect. From the perspective of young renters, it's a catastrophe. But the government serves the former, not the latter. Now here's what I'm convinced of. Housing affordability will not improve materially in America until one of 3 things happens. First, wages genuinely accelerate much faster than home values for an extended period. That might take a decade, and it requires wage growth that's neither certain nor guaranteed. Second, mortgage rates fall to historic lows outside of a recession, and somehow housing supply increases enough to prevent those lower rates from capitalized into higher prices. That's theoretically possible, but practically implausible. Third, home prices crash. That requires a major recession or policy shock severe enough to crack the homeowner constituency. And once that happens, the political consequences are so severe that whatever government allowed it to happen will lose power. So we're trapped in affordability stagnation. 88 million homeowners are happy. Millions of young renters are miserable. The government floats policies that make headlines but solve nothing. And the housing market remains what it's always been: a zero-sum game where one group's gain is another group's loss. Trump said it himself in December. He wants to take care of the people that have houses that have a value to their house that they never thought possible. That's his political base. That's his constituency. That's why housing affordability will never be fixed. The one sentence to remember is this: in a democracy, you cannot solve a problem that requires harming millions of voters, even if solving it is economically rational and morally necessary. This is Avi. Like and subscribe. On to the next.